Over 1.2 million British pensioners are already living overseas, and that number is growing faster than at any point in the past decade. When you understand why, it makes complete sense. The full new state pension in 2026 pays £241.30 per week, which is £12,548 per year, and as we covered in a previous video, that does not even cover the ftse minimum retirement standard of £14,400 for a single person living in the UK. But take that same £12,548 and move it to the south of Spain, to the Algarve in Portugal, or to Chiang Mai in Thailand, and suddenly, it buys you a completely different life. In some of these destinations, the state pension alone is not just enough for a minimum retirement, it is enough for a comfortable one. Today we are going to do something very specific. We are going to show you exactly what daily life looks like in all three destinations on a UK pension, the real monthly costs, the visa requirements, what happens to your pension when you leave, and the one critical difference between Spain and Portugal on one hand and Thailand on the other, that most people only discover after they have already made the move. By the time you finish watching this, you will have a clear picture of which destination makes the most financial sense for your situation, and which ones come with risks that most retirement content never mentions. Let's start with the single most important thing you need to know before you even think about where you want to live, and that is what happens to your state pension the moment you leave the UK. Because the answer is not the same for every country, and getting this wrong can cost you tens of thousands of pounds over the course of your retirement. The UK state pension is uprated every April under the triple lock, which guarantees it rises by whichever is highest out of average earnings growth, CPI inflation, and 2.5%. If you retire to Spain or Portugal, which are both in the European Economic Area, your state pension continues to receive those triple lock increases every single year, just as it would if you were still living in Birmingham or Bristol. This is protected under the UK-EU Trade and Cooperation Agreement signed in December 2020, and it remains in force for 2026 with no changes expected in the short term. But if you retire to Thailand, which is not on the UK's Social Security Uprating Agreement list, your state pension is frozen at the rate it was when you first claimed it or first moved to Thailand. No increases, no triple lock, nothing. Every April, when pensioners in the UK see their payments go up, yours stays exactly where it was. You need to understand what that means over a long retirement. If you retire to Thailand in 2026 at age 67, and you claim the full new state pension at £241.30 per week, that pension will still pay £241.30 per week when you are 87. Assuming 3% average inflation over 20 years, that frozen pension will have lost approximately 45% of its real purchasing power over the course of your retirement. And since Thai living costs are also rising, albeit more slowly than UK costs, you can see how a retirement that looks very comfortable at 67 could look very stretched at 77 or 80. That is not a reason to rule Thailand out entirely, but it is the most important number in this entire video, and it needs to be the foundation of your planning before you make any decision. Now let's look at what life actually costs in each destination and start building a real picture. Spain is home to more than 250,000 registered British nationals, making it by far the largest British retirement community in Europe. The concentration on the Costa Blanca, the Costa del Sol, and the Balearic Islands means that in most of these areas, you can live comfortably in an almost entirely English-speaking environment, without needing a word of Spanish if you don't want it. The climate in southern Spain is exceptional, with hot, dry summers and warm winters that rarely dip below 10 degrees Celsius. The food is genuinely some of the best in the world, and a menu del dia, which is the set lunch menu served at local restaurants, typically costs between 10 and 15 euros for 3 courses including a drink and a coffee. That context matters enormously when you are building a retirement budget. So what does a realistic monthly budget in Spain look like for a single British retiree in 2026? Renting a two-bedroom apartment in a coastal area like Alicante, Torrevieja, or the Costa Blanca, rather than the more expensive cities of Barcelona or Madrid, you are looking at approximately 650 to 800 euros per month for rent. Groceries for one person, buying fresh local produce from the markets and cooking most meals at home, runs around 200 to 250 euros per month. Utilities, including electricity, water, and internet, come to roughly 120 to 140 euros per month. Private health insurance, which is mandatory for the non-lucrative visa that most British retirees use to live in Spain, costs between 50 and 150 euros per month, depending on your age and the level of cover you choose. Transport, whether a local bus pass or occasionally renting a car for day trips, adds roughly 30 to 50 euros. And personal spending, leisure, dining out a few times per week, and social activities adds another 200 to 300 euros. That gives you a realistic total for a comfortable single retirement in coastal Spain of approximately 1,200 to 1,600 euros per month. At the current exchange rate of approximately 1.17 euros to the pound, that works out to roughly 1,025 to 1,370 pounds per month. The full new state pension of £241.30 per week is approximately £1,046 per month, which means on the full state pension alone, with a moderate lifestyle in coastal Spain, you are essentially breaking even or within a very small margin. And if you have any additional workplace pension or private pension income on top of that, you are living comfortably with money to spare. Critically, in Spain, your state pension continues to rise every April under the triple lock. So as the years go by, your income grows, while your costs in Spain rise only at the Spanish rate of inflation, which has historically been lower than the UK's. But there is a practical requirement you need to address before you can legally live in Spain. Post-Brexit, as a UK national, you are no longer an EU citizen, and you no longer have the automatic right to live anywhere in the EU. You need a visa, and for most British retirees, the right route is the non-lucrative visa, or NLV. The NLV requires you to prove a minimum monthly income of approximately 2,400 euros for a single applicant, which is roughly £2,050 per month at current rates. That is significantly more than the state pension alone provides, which means the NLV is not accessible to people living solely on the state pension. You need additional pension income, savings income, or rental income to meet that threshold, and you need comprehensive private health insurance from a Spanish-approved provider. The application is made at a Spanish consulate in the UK before you move, and processing typically takes 2 to 3 months. The good news for those who can meet the income threshold is that once you have Spanish residency, you can access the Spanish public healthcare system, which is ranked as one of the best in the world, and which for residents effectively becomes free at the point of use beyond your private insurance requirement during the visa application period. You also qualify for the S1 healthcare entitlement, which allows UK state pensioners to access state healthcare in EU countries at UK taxpayer expense. So in practical terms, once you are established with residency in Spain, your ongoing healthcare costs can be very... Now let's talk about Portugal, because in many ways, Portugal is the smarter financial option for British retirees, particularly those with more modest incomes. Portugal has been growing in popularity dramatically over the past decade, driven by a combination of genuinely low living costs, a climate that is milder and more pleasant than most people expect, excellent healthcare, a slower pace of life, and one of the most accessible retirement visa systems in Europe for non-EU nationals. The cost of living in Portugal, particularly outside Lisbon and the most popular tourist areas of the Algarve, is genuinely lower than Spain. According to Numbeo and multiple independent analyses in 2026, overall consumer prices in Portugal, excluding rent, are approximately 26% lower than in the UK, and housing costs, particularly outside the prime areas, are significantly cheaper than equivalent Spanish coastal properties. The Algarve is Portugal's most famous retirement destination, with a coastline of dramatic beaches, a large established British expat community, excellent golf courses, and 300 days of sunshine per year. But it is also the most expensive part of Portugal for rent and property. Outside the Algarve, the Silver Coast north of Lisbon, the area around Setúbal south of Lisbon, and university cities like Coimbra offer even lower costs with the same quality of climate and lifestyle. A realistic monthly budget for a single British retiree living comfortably in the Algarve or the Silver Coast in 2026 looks like this. Rent for a comfortable two-bedroom apartment in a non-prime area runs approximately 700 to 900 euros per month. Groceries at local Portuguese markets come to around 170 to 200 euros. Utilities, including electricity, water, and internet, cost approximately 100 to 120 euros. Private health insurance for the D7 visa process costs around 50 to 100 euros per month for a standard policy. Leisure, dining out at local restaurants which are extremely affordable compared to the UK, and occasional travel adds another 200 to 250 euros. That gives a realistic total of approximately 1,200 to 1,500 euros per month, which converts to approximately 1,020 to 1,280 pounds at current rates. And that is within reach of the full state pension, with a small additional income source or savings buffer. The visa route for Portugal is the D7 passive income visa, which has a notably lower income threshold than Spain's NLV. For 2026, the D7 requires proof of a minimum monthly passive income of 920 euros per month, which is approximately 785 pounds at current exchange rates. That is close enough to the state pension level that many British retirees, who also have even a modest workplace pension, can qualify comfortably. After 5 years of residency in Portugal, you can apply for permanent residency, and after 5 more years, Portuguese citizenship, which comes with an EU passport, one of the most valuable travel documents in the world. Portugal also taxes foreign pension income at progressive rates under normal tax residency rules, so it is worth seeking advice from a Portugal-based tax specialist before you move to understand your full tax position, including whether the double taxation agreement between the UK and Portugal affects the tax you pay on your UK pension income in Portugal. And importantly for British retirees, Portugal is in the EEA, which means your UK state pension continues to receive triple lock increases every single year, exactly as it does for Spanish residents. The same UK UTCA protection applies, and it has been confirmed in successive reviews as stable for the foreseeable future. Now let's talk about Thailand, because this is where the conversation gets most complex and most misunderstood, and where the gap between what the retirement lifestyle brochures say and what the real financial picture looks like is widest. Thailand genuinely offers an extraordinary quality of life for a fraction of what the equivalent lifestyle would cost in the UK, or even in southern Europe. A single retiree living comfortably in Chiang Mai in northern Thailand, which is consistently ranked as the most popular and affordable destination for British retirees in Southeast Asia, can live very well on approximately 50,000 to 65,000 Thai baht per month. At current exchange rates of approximately 43 to 45 baht to the pound, that works out to roughly 1,100 to 1,500 pounds per month. That buys you a modern one-bedroom or two-bedroom apartment in a good area, utilities fully paid, street food that genuinely costs under £1 per meal when you want it, restaurant meals of good quality for 3 to 5 pounds, private health care at internationally accredited hospitals that are better than most NHS options in the UK at a fraction of the cost, and a social life within the largest and most established British expat community in Southeast Asia. Chiang Mai has a cool season from November to February that makes it genuinely pleasant year-round, and an extensive infrastructure of English-speaking services, legal advisors, expat clubs, and international supermarkets that make the transition significantly smoother than moving somewhere with no pre-existing British community. The retirement visa for Thailand is the non-immigrant OA visa, which is available to anyone aged 50 and over. You need to either maintain 800,000 Thai baht in a Thai bank account, which is approximately 18,000 pounds at current rates, or show a monthly income of at least 65,000 Thai baht per month, which is approximately 1,450 pounds. And here is something important for British retirees to understand. The state pension alone, at £241 and 30 pence per week, or approximately 1,046 pounds per month, does not meet the monthly income threshold on its own. Most British retirees who choose Thailand combine their state pension with a workplace pension, a private pension, rental income from a UK property, or a combination of savings to demonstrate the required monthly income level. The visa is renewed annually, and you must report your address to Thai immigration every 90 days, which can be done online or in person. Health insurance with minimum coverage of 3.2 million Thai baht for inpatient and 400,000 baht for outpatient care is required for the OA visa. Comprehensive annual international health insurance for a healthy retiree in their 60s typically costs between 1,500 and 3,000 pounds per year, and this needs to be factored into your budget. Because unlike Spain and Portugal, where you can ultimately access public health care through residency arrangements, Thailand requires you to privately fund your health care for the duration of your retirement. But here is the number that changes everything for Thailand, and it is the one that most retirement content about Thailand glosses over or buries at the end. If you retire to Thailand on the full new state pension of £241 and 30 pence per week, and your pension is frozen at that level for the rest of your life, and you live for 20 years in retirement, your pension will still be paying £241 and 30 pence per week at age 87. In real terms, assuming 3% average annual inflation, that frozen pension will be worth approximately £133 in today's money by the time you reach 87. That is a 45% reduction in real purchasing power over 20 years, from a starting point that was already below the UK minimum retirement standard when measured against UK prices. And while Thai costs are lower and rise more slowly than UK costs, they are not completely immune to inflation. The exchange rate between sterling and the Thai baht is not fixed, it has been volatile, and a weaker pound means your frozen pension buys fewer baht each year, even if the nominal amount in pounds is unchanged. There is also a new tax consideration that came into effect in Thailand in 2024 that every British retiree needs to understand before choosing Thailand as their home. If you spend 180 or more days per year in Thailand, you are a Thai tax resident. Under the rules that changed in 2024, any foreign source income remitted into Thailand in the same year it is earned is now taxable in Thailand under Thai progressive income tax rates. This includes your UK pension income if you transfer it into your Thai bank account in the year you receive it. This rule change has significantly altered the financial calculation for Thailand retirement, and you absolutely must get specialist tax advice from an advisor familiar with both UK and Thai tax law before you move, because the interaction between the UK-Thailand double taxation treaty and the new Thai remittance tax rules is genuinely complex, and the consequences of getting it wrong can be costly. So let's bring this all together, because the real question is not which of these three destinations sounds the most appealing. The real question is which one makes the most financial sense for your specific pension income, your savings position, your health status, and your life stage. If you have the full state pension plus a workplace or private pension that together give you at least 2,000 to 2,500 pounds per month, Spain offers the most mature and accessible British retirement community in the world, with triple lock pension protection, upward lifestyle mobility, the ability to access excellent public health care over time, and direct flights to any UK regional airport several times a day. The non-lucrative visa income threshold is the main barrier, but once cleared, Spain offers extraordinary value compared to the UK. If your pension income is more modest and you are looking for the best possible quality of life at a lower overall cost, Portugal, and particularly the Algarve and Silver Coast, offer the most compelling financial case. The D7 visa has a lower income threshold than Spain's NLV. Your state pension continues to rise every year. Living costs are genuinely 25 to 30% lower than Spain outside the prime tourist areas. Healthcare is excellent. The lifestyle is outstanding, and the path to EU citizenship after 10 years is a genuinely valuable long-term benefit for anyone who values freedom of movement across Europe. And if maximum value for money is your primary goal, and you are comfortable with the complexity of the frozen pension, the annual visa renewal, the 90-day reporting, the mandatory private health insurance, and the new Thai remittance tax rules, Thailand, particularly Chiang Mai, offers a standard of living at a monthly cost that is genuinely extraordinary by UK standards. But you need to plan for the frozen pension from day one. You need to understand that your real income will shrink in purchasing power every year, and you need to have private savings or investment income that grows over time to compensate for the pension freeze. Because relying on a frozen pension alone into your 80s in Thailand is a plan that starts well and becomes genuinely difficult as the years accumulate. The one question that ties all of this together is this: how long is your retirement likely to be? And how do you want the financial picture to look, not at 67, but at 77 and 87? Because the best retirement destination is not the one that looks most attractive on day one. It is the one that keeps working for you financially and personally over the full arc of your retirement, and that answer is different for everyone. If this helped you think more clearly about your retirement options, please hit the like button and subscribe to UK Finance with Peter for more straight-talking content on money and retirement for people living and working in the UK. Thanks for watching, and I will see you in the next one.